Bonds are back in favour, but can a smart strategy top momentum? This is Inside ETFs, and we're talking about fixed income. After a decade of suppressed yields, bonds are re-emerging as a core engine of returns, and the money is flowing into funds. With the vast majority of the bond market now yielding above 4%, the setup is powerful. But a great year doesn't guarantee a repeat performance. So with 2026 coming fast, how do you turn today's yields into tomorrow's wins? Let's ask Steve Laipply, Global Co-Head of iShares Fixed Income ETFs at BlackRock. So Steve, nearly $1 trillion has flowed into ETFs so far this year, with bond funds taking a third. What's driving such a banner year?
I think you nailed it. Yields are at levels that we haven't seen in decades, literally, and I think investors have responded very strongly the last couple of years. If you look at the market, like you said, we have across sectors yields well above 4%. Returns year to date have ranged in the 6 to 8% in the U.S., depending on what sector you're in. And investors are realizing that income is actually an important part of the portfolio and have returned to income strategies and also to help diversify their riskier assets. So I think it's that simple. Investors are simply responding to the opportunity in front of them.
Well, the US is staring down massive deficits and a mounting debt load that won't disappear anytime soon. How sustainable is this run over the long term?
Well, that's an interesting question, and it's one that's multifaceted and depends on a lot of variables. The market knows this, and term premium is still hovering around levels that are probably higher than in over a decade. So the market is aware of the fiscal picture, and it's really a question of, what's the U.S. Response in terms of growth? What's the U.S.'s relative position? So right now, yes, we have a positive yield curve in the long end. The market is pricing in more term premium than it has in quite some time. And so there is a dynamic where this risk is being evaluated right now. Could yields still price in more? That remains to be seen. But this has been known in the market for a while now.
Let's look at recent performance, though, and Treasuries just had their worst week in 8 months as data shook expectations for next year's Fed cuts. Could a slower easing path spell trouble for bond ETFs?
Well, it's interesting because we have seen, if you go back over the last year, over the last couple of years, we have literally watched 10-year treasuries round trip from, sort of the high threes approaching 5 all the way back down again. The backup in yields just in the last couple of weeks is really only about 10 to 15 basis points. So yes, there will continue to be volatility in these yields. What is very, very interesting, though, is that investors don't really seem to be fazed by that. They continue to allocate. So even on days when yields have backed up, we continue to see positive inflows. And if anything, I think investors often look at a temporary backup in yields as a buying opportunity. So there will continue to be volatility in yields, but I think investors are focused on the long term and again, just building out that income component of the portfolio and taking advantage of these yield levels, irrespective of volatility.
Well, BlackRock is turning bearish on long-term treasuries, citing a wave of AI-related financing that could push up borrowing costs. Should investors be worried?
Well, I think, if you do look at the AI term structure, a lot of the deals have come in the long end. But again, the market has been pricing this. I think where investors are really focused is ultimately where the Fed is going to where the Fed's going to take yields. And so, if we look at what's priced in the market, we've been looking at a terminal rate of around 3%. That takes you out to 2027, though. So the debate is how fast, right? So we'll see what happens this week with the Fed. And then the question is, will they back off? The market seems to think there will only be a couple of cuts next year, and then heading into 2027, finishing off around that 3% level. That obviously can change based on employment and labor conditions, et cetera. But I think, again, the market has been looking at AI issuance, has been understanding the patterns and maturities, and is pricing that in. So I don't think it's a particular concern, but it's something that investors are keeping an eye on. We've recommended staying more in the belly of the curve. Short end yields are attractive, but it does make sense, we think, at this point to add some duration, but that being more, between the sort of the 5 and 10 year point.
So finally, Steve, the rigid passive bond funds of the past may not cut it in 2026. What other strategies are you recommending?
Well, I think the strategy that we recommend most is really having a diversified source of income streams. And that can look anything from holding a core index bond fund alongside of an active bond fund. It can involve augmenting that with maybe higher income strategies like high yield. But I think really it's going to be very, very hard to sort of time yields. And so when people often ask us, oh, do I go index or active? Our answer is both. So you want to have, sort of a low-cost, transparent core strategy at the heart of your portfolio for that, sort of steady income. But then I think there are an enormous amount of opportunities in the market, and an active manager can be well suited to take advantage of that. So, for example, we often see investors pairing our aggregate index fund with our income fund, BINC. That's just an example, but we see investors using both in reality.
It was Steve Laipply from BlackRock. Don't forget, you can watch more videos on Reuters.com.